companies go through different development stages over time, and nowhere is it said these phases should coincide with an industry's development stages. That's why it is very important for managers to recognize these stages and the possible challenges and obstacles they will likely face in each phase. This would help them manage change more effectively and apply different approaches to be successful. We can identify 7 development stages in a company's life cycle. Each is unique and represents a challenge from a different perspective. Typically, a company's life cycle starts with a seed stage. Then, if things go well, a startup will be formed. Once the startup grows, we'll be in growth stage, followed by the establishment and expansion phases. The final 2 stages of a company's development are maturity and possibly an exit. Let's dig deeper and describe each of these stages in more detail. The seed stage starts when a business idea is born. This is when you decide to set up a company. However, before starting it, it would be reasonable to verify the feasibility of your business idea. Discussions with other people can be fruitful. Industry specialists, business associates, and even family and friends can help you formulate your idea and decide on a plan of action. An entrepreneur must imagine the whole process and make sure there is a match between the business scope and his personal background, experience, skills, and passions. You will have to make several decisions related to business planning, ownership structure, staff recruitment, and financing. Having a clear idea how the venture will be financed and what resources you will need in the first months of operation is critical, given that during this period, the new company will likely operate producing no revenues and will incur significant costs. If you plan to contact investors, present to them a well-thought-out business plan that includes a 3 to 5 year projection of financials. If everything goes well in the seed stage, you can form a startup company. Studies have shown this is the riskiest stage over the entire life cycle. 90% of startup companies fail, so founders must be careful in this phase. Usually, during the startup phase, the firm can take one of its products or services to market and see if clients perceive it in a positive way. Active listening allows for much-needed fine-tuning and product improvement. In addition, the firm must focus on building a lasting relationship with its first clients. Using cash flow in a reasonable manner is high on the list of priorities. In addition, the time to take products to market is crucial at this stage, as it would allow the company to register revenues and cover some of its expenses. Once a company takes its product to market and starts selling it to an increasing number of customers, it enters the growth stage. This is when the majority of companies reach break-even and are generating sufficient revenues to cover their expenses. 2 conflicting phenomena occur here. The company needs its founders' attention for multiple issues, like customer satisfaction management, administrative tasks, management of daily activities, and employee feedback. But she shouldn't miss the big picture and underestimate her role as a company head. That's why it's time to think about hiring personnel who can take over some of the founder's responsibilities. Once they are on board, the founder must think about how to define and communicate the firm's goals and how to motivate staff towards the firm's vision. It's highly likely the company must invest in new management and accounting systems at this stage. To cope with increased competition, the company should continue to invest in innovation and advertising. By the onset of the establishment phase, the company's operations are standardized, and it has a stable stream of revenues. The focus falls on implementing sound business practices and on boosting productivity through automation and outsourcing. It is likely the founder must delegate some further decision-making authority to division heads and consultants. Companies that have done a good job in the growth and establishment phases will probably enter the expansion stage. It consists of geographical expansion or expansion across other products or distribution channels. When going internationally, a new set of topics arises. You have to wonder if the existing capacity is going to cover the expected demand you will have in the new markets. What are the competitive advantages of your products in these markets? How are you going to deliver your products locally? Will you have a website in English only? Are you going to accept online payments? Of course, having a successful business locally does not mean this will transfer into an immediate international success. After a while, a company that has successfully gone through the expansion stage enters maturity, which is characterized by stable sales and profits. Growth of revenue slows down, but that doesn't mean these aren't good times for the firm's owners. The beginning of the maturity phase is when they make the most money. However, the maturity phase can also be characterized by a strong level of competition, which results in losing market share. Many mature companies try to sustain their business by finding new business opportunities and fueling the growth of the mature part of their business. At this stage, shareholders must decide whether to expand the business even further or exit the investment. An exit typically consists of selling the company to another firm operating in the same industry or to financial investors. These are the life cycle stages a company typically goes through. Understanding what can be expected in each is a must for anyone who wants to start a business.